Well, first off, thanks for having me here today. And what we're going to do is talk about my favorite go-to option strategy, which is we'll call it the high reward, low risk option trading, and that's using the option butterfly. So it's really an amazing option trading strategy, and it's a strategy that I first got introduced to back in the early 2000 area, I guess. At that time, I set up an over-the-counter crude oil options brokerage desk for PVM Oil London. It's a large oil brokerage company, and so set up an institutional over-the-counter options brokerage desk for that group. And we were brokering oil options for big institutions, banks, hedge funds, et cetera. And so we did a bunch of these butterflies, just thousands of these contracts for some of the hedge funds. And so they're just really an amazing strategy, but there's so many different ways that you can use them. So that's what we're going to be talking about here today. So appreciate the introduction. And yeah, I've been at the trading business for over 30 years and started out on the crude side, but the company that I ran the trading desk for over 10 years, we were big in crude, but we eventually diversified out into all the other big derivative areas, all the different futures markets, foreign exchange, so you name it, we were trading it. So it was a great learning experience, for me. Now, first off, trading for yourself can be just one of the most rewarding jobs on the planet out there, but you really need to stay, educated about what you're trading. The main thing too is you'll find out as you go is managing your trading risk. So it can also be super painful and stressful at times, which I'm sure probably everybody here can attest to. So today I'm going to share with you one of my favorite, like I said, go-to strategies, which is the butterfly, and it's really it is kind of what I call that low stress strategy. So let's get started. So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now ask yourself this: what if you could add a trading skill of a high reward option strategy that requires little capital and delivers winning low stress trades that generate consistent trading income? Could this literally change your life? Well, it really can, because what you're going to see here today is some strategies that, once you add to your toolbox, I think will really help you just kind of smooth out your trading. So, I've learned and taught a lot of different trading strategies over the years, but when I thought about the most valuable go-to type of trading strategy that could really help literally every single trader more than anything else, I knew it was going to be the butterfly spread. So the huge advantage of the butterfly strategy is that its unique framework, it allows for more consistent and greater returns due to its simple but dynamic structure. And because it requires only a small amount of capital, of your hard-earned capital, your trading stress can basically be just very, very low. Now here's what we're going to get into today, sorry about that. What makes butterfly the most lucrative low-risk strategy for any market environment? How exactly to set up a butterfly trade, core concepts you need to know to construct a butterfly, most important option factor and how to capitalize on it, how to use Theta to increase your trading success, how option pricing works in order to know how to take advantage of it, and then selecting the right butterfly strategy for the market conditions you're trading in. And I'll show you, my favorite types of butterflies, and how you can use this for hedging, and some really great examples. So, why trade the butterfly? It's really an amazing, unique trading strategy, first off. But unlike other strategies such as the iron condor, credit spreads, and debit spreads, butterflies are very dynamic and can be traded for a variety of different reasons with different goals in mind. So, in other words, you can learn how to trade butterflies, and you're covered for either the offense side of the trades or the defense, and your goals can then be kind of protected by the structure of a butterfly. So these can work no matter what the market's doing. It can be up, down, sideways, They can provide income from stocks that are going nowhere. They're delta neutral, so tend to work no matter what happens in the market. They can really help you to eliminate the stress of your trading by trying to pick direction of stocks or overall market direction at times when the markets are just kind of churning, going sideways. And they're really helpful to be a strategy that eliminates time decay expense that many traders will have from just constantly buying options. So when you've been in a cycle where the markets are really chopping sideways and you're constantly just buying options, you know what that can do to you based on the time decay. So it also takes out the unsettling guesswork sometimes out of your trading, and they can be constructed for very low cost, and at times you'll see risk reward or reward to risk ratios of higher than 10 to 1. Now, the benefit is butterflies are very flexible, as you'll see as we go forward in this presentation. Now, once you learn the setup, you can then adapt it for both of your goals, and you can use it for your market insights, or you can use it for delta neutral or directional types of trades. So one thing they can be structured for delta neutral, and the beauty is that they can also be used for directional type of trades, offering you a bullish or bearish exposure to the market when you feel pretty sure a stock looks great for headed up or down. But if you're wrong, the butterfly, the way it's structured, helps you to manage your risk and also at the same time retain large potential returns. So it's really kind of a win-win strategy when you get the right situation, which is most of the time. So it's one of the strategies that I use. For me, and I tell all my members and clients that trading is basically 99.9% directional, and then it comes down to managing risk. So when I'm doing a trade setup, the first thing I go to is look, can I do these different types of butterflies to reduce and manage my risk? So it's my first go-to type option strategy. So we'll also have to be real about it though. The butterfly spread cannot offer you unlimited profit potential, but they usually will cost you so much less than just buying outright options, and they really do offer an amazing positive risk reward trade setup. So this means that the butterflies can significantly increase the probability of a winning trade while also reducing the risk of that trade, and that really is what trading is all about. So butterflies, they can be used for hedging. So if you don't get anything else out of this presentation, what I'm going to show you here today, the main thing that I found from my experience of trading and my go-to type of strategy for hedging is to use the butterfly. It's a really quick and dynamic way to totally neutralize your risk and reduce your risk, and also that reduces your stress. So the directional butterfly can be used as a fast, low-cost way to what I call cover your ass pronto when a position's moving against you. So here's a tip. Now, constructing a butterfly around a strike that's under pressure from another core trade, such as if you had a credit spread on or a debit spread and it's going against you, this creates a great way to control your risk and lower that trading stress. So you can neutralize the risk really fast. So, it's what I call that cover your ass hedging. So you can keep the original position open, and how many times have everybody here, you've been into a trade, you get into it, looks really great, you love the idea, you love the setup, and it starts out going in your direction and you like it, it looks great, and then all of a sudden it stalls and it loses that momentum and just flounders. And so you get out of the trade or you stop out, and then all of a sudden it goes back in the direction you originally planned the trade for, and it made a lot of money, and you're frustrated about that. Well, one thing with the butterfly, when you use it properly, you can use it to defend that original core trade, and it buys you time, because part of the component of a butterfly is a positive theta type structure. So what happens a lot of times, you'll see trades that start to stall out, then they recover and start moving, and at that point in time you can then just take the butterfly hedge off and go with the original trade. And the other great thing about it, since it is a positive theta type of structure, a lot of times that adjusts the original core price of your trade from the theta decay that you got from the butterfly. So They can also be very, very useful for, investors or longer term, type traders or swing traders. So long-term out-of-the-money put butterflies, a lot of times you'll find that they're, very can be very expensive when you're just buying puts to hedge a position. But if you do put butterflies, they become a really great portfolio management tool that you can do to hedge a position. Um, so they're also very low maintenance. Butterflies are sometimes called what I call a vacation trade due to their low risk and need to only be frequently monitored. So you don't have to just when you put on a butterfly trade, you can take off, and you don't have to frequently monitor the trade until that week of expiration. So a lot of times you might get a really great trading idea. You put the trade on as a butterfly, take off, come back, week of expiration, and a lot of magic can start to happen. So the butterfly trade, again, is generally very slow moving early on, but get exciting and more volatile as you approach that expiration. And then they get within what we call the profit tent. So here's the typical structure, what it looks like on a butterfly. You can see that you've got, this is what we call the tent. So when you get towards expiration, the price starts, if you get towards your pinning price of the strike that you're using the body of the butterfly, your max profit is at that apex of that top of that tent. So let's say, for example, if you had a butterfly spread that you'd put on, and last Friday was the expiration, and the price of your spread was 130 was your body, and it gets up here towards the close, that's going to be your max price. But you have profit all the way in between, and then it just keeps getting better and better as you get closer to expiration. And a lot of that's because of that structure of the volatility coming out and the time decay being stripped out and going to zero. So a big component of that is time decay and implied volatility. So you'll see how that works, but you can get a great potential return on very low capital risk based on that kind of structure, and that's within that profit zone or profit tent. So let's take a look and look at a structure of a butterfly, the typical structure. Now, the butterfly, there are a bunch of different variations, but this is your typical, what we call the balanced butterfly. So we'll say XYZ company is trading at $43.57, and you put on a butterfly. So we're going to buy to open one contract of the $42 calls at $2.38, sell to open two contracts of the February 43 calls at $1.67, and then buy another leg, one leg, at the February 44 call at $1.06 per option contract. Now remember, one option contract is equivalent to controlling 100 shares. So if we go through the math on this, we bought one contract here of the 42 calls at $2.38. We bought one contract of the 44 at $1.06. So then we had sold two of the 167s times 100 to convert it to a contract basis. So that puts you in $10 per option contract. So very, very low capital outlay, low capital at risk in this type of structure. And if you look at this, this is why it's called a butterfly, the body. You can see here you've sold two contracts at that, in this example, the 43 call. And then here's your wing out here. You bought that. So that's the 42 call and the 44 call there. So, you can see it's a dollar-wide spread, and you've got your body inside where you have your two short contracts and then protected by that outer wing on both sides. Now, your calculation of profit then becomes taking that middle strike, in this situation, $43 call, minus your lower call of 42, less the debit paid, which was $10 times 100, and you can see that that's the difference is your profit, which would be, in this example, $90. So 43 minus 42 minus your cost equals 90 cents, or $90 per option contract. So based on that, you can see huge amount of potential upside risk reward or return on your capital. In this example, over 900 or 900% or 9-to-1 reward to risk. So that's the beauty of it, and these things are, again, trades that you can put on. You don't have to frequently monitor. Plus, you know your downside risk is so minimal that you're not too stressed about it. So that's your typical construction. Now, the core concepts you really need to know in order to construct your butterflies, and in options in general, these are the kind of core concepts you want to understand, is first off, the most important option factor for options and for profit generation using the butterfly or any type of option strategy really comes down to understanding the concept of time and theta and pricing and their effects that they have on the price of an option. So let's review these core concepts so you can understand how pricing components affect the option price and how then you take advantage of that. And one great concept is to use the butterfly to do that. So first off, there's time value, and this is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And the butterfly strategy is very tied to time value and the impact that it has on the price of the option. So first off, time value is also what we refer to as the extrinsic value of the option, and it's the premium that a rational investor would pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always greater than zero, thus an option is always going to be worth more than its current exercise value. Now, the change in the value of an option based on this time decay, we can measure that theoretically using the Greek called theta. So, in summary, if you're a buyer of an option, you're going to be willing to pay a little bit extra for that time that it gives you for your trade to work out. And as a seller of an option, you're going to want additional premium for taking on that risk. And in trading, time equals risk, because the more time that you sit in a trade, the more potential things can go wrong. So let's take a look at theta decay. Now, this is the great thing about options too. You've got these various Greeks where you can use to measure certain things and measure price and help you to kind of forecast price. Now, the theta part of the Greeks tells you how much an option price will diminish or go down over time, and that's the rate of time decay, of a stock's option. And time decay occurs because the extrinsic value or the time value of an option always diminishes and goes down as you get near to expiration, and will go to zero, basically at expiration. So by expirations, options have no extrinsic value, and all out-of-the-money options are going to expire worthless. And it's this rate of this daily decay all the way up to its expiration can be estimated theoretically by the option theta value. So by understanding option theta becomes extremely important for applications of various option strategies that seek to profit from the time decay component. So option theta values are going to be characteristically, you can either say they're going to be positive or negative. So all long stock options, so if you are long a call or long a put, that's going to have a negative theta value. Excuse me, which indicates that they're going to lose value as expiration draws near. And all short stock options or options positions have what we call positive theta values. So if you're short a call or short a put, it has positive theta value, which indicates that this position will actually gain value as expiration draws near. So by knowing the characteristics and how then to incorporate that and take advantage of it becomes a huge benefit for using options. So remember, theta value is going to be highest at the money for options, and it gets progressively lower as you go deeper in the money or out of the money. And in the money and out of the money options have much lower extrinsic value. That's why it's giving you less time left in the option for that time decay. Now, here's an example. So if you have an option contract and you look at your option platform, and you see that it has a theta value of minus 10 cents, this is basically saying that it's going to lose $10. Remember, one option contract is equivalent to 100 shares, would lose $10 per contract every day, even on weekends and market holidays. So if you were a buyer or holder of this option contract over a 3-day weekend, and that price where you had taken bought that option was $1.40 or 140 per option contract, and the option has that minus 10 cents theta decay, you're going to find out that the price of that option is going to be $110 instead of $140 that you originally paid after a 3-day weekend. So if price goes nowhere and you come back after 3 days, that price has gone down. It's going to be only worth 110. So that's, your theta decay strikes. And you want to be aware of that as a buyer of options, or you want to be aware of it to take advantage of it. So option theta, it also doesn't have to remain stagnant. So it's going to increase as expirations draw near and decreases as the expiration goes more and more in the money and out of the money. So in fact, the effects of option theta decay is most pronounced during the final 30 days to expiration. And when you get into those weekly options, that's where it really soars. And I call it, it's kind of turbo time decay. So here's an example of kind of a time graph. And you can see when you first start out with an option and you're 120 days out, you're going to see on this table, on this chart, that the time decay is almost flat. You can barely see it. But as you get 30 days out and as you get into your weekly options, it really starts to accelerate. So it's kind of like a swift current going out. And if you're a swimmer trying to go against that current, you're not making much headway. And it's going to go to zero at option expiration. So if you're buying options, you better be looking for a really good strong push to the upside. Let's say if you bought calls when you have this accelerated time decay. So a lot of times it's going to be best to maybe go with that flow, and you might want to be selling options, and that's one big component of the butterfly, which you'll see. Now, how does option pricing work? So in order to understand and use and get the edge of options and understand it over lesser sophisticated traders, by understanding the key components that go into option price will really help you to understand what options are all about, and then how to select and look at the right option strategies. So the key components for value in option comes down to, again, that time value, and then times implied volatility, and then times the intrinsic extrinsic value, or the underlying value of the security you're trading. So these are the key components for price. There are other Greeks that go into it, but these are the key ones. And once you know these variables, then you are ready to price the option and know what option premium you should use. So here's a table to illustrate how this works. So now most of the big options, most of the big stocks, etc., will have weekly options. So here's a weekly chain. So on a weekly option, every Thursday you get a new series. And so that first day on a Thursday, you're going to have 100% time value in that option. So time value times the implied volatility and times the intrinsic value, or the underlying value. We'll keep this a 1 to make it constant, so you can see how the effects of implied volatility and time value work. One second. So you can see how pricing flows. So that first day, you've got 100% time, and we put implied volatility at 300, so you get a price of that option of $300. Now, if you just come down here to Monday, then you can see that all those days have gone by. Now you've only got 50% of the option time value left. And even if you increase the implied volatility, spike it up in this case to 800, and that's constant, you can see that your premium barely went up. Now, look here, if you had your implied volatility of only 300, and now you've got the time portion only 50%, you can see that then your option premium is only 150, so it's going down. And the key thing is to notice is that time value will go to 0 and implied volatility goes to 0. So it's a decaying. These are two components that are decaying or going down. So you need to be aware of that and try to be always trying to take advantage of it. So those are things that you want to be aware of for any kind of option buying or selling. Now, this knowledge really comes down to being power for you, and it can be used to your trading advantage. So how do you then choose the best butterfly strategy for your trading goals? So, one major goal of every trader, in my opinion, really should be to select trades that are based on what's going to provide you the most consistent positive return with low defined risk and not always the greatest return. So, as a trader, I like to have really kind of a smooth or equity curve. I don't like to have a lot of volatility and, a lot of stress for trades going up and down. So this is one strategy that can give you that kind of smoothness to your equity. And one of the best ways to then achieve, this goal is by being aware of the different option butterfly strategies that are available, and then understand how they work, and then select the one that's best suited for the market environment you're trading in and your specific, goals that you have as a trader and your specific profile of risk that you're looking to achieve. Now here are the various butterfly strategies. You've got a long call or put butterfly. You've got short call or put butterflies. You've got what we call a broken wing, sometimes called the skip strike butterfly. And you've got the unbalanced or ratio butterfly. This is my favorite right here. It's great for directional trading. And directional, balanced butterfly, iron butterfly, and then hedging using butterflies. So a lot of different variations of the butterfly strategy itself. So next, I'd like to show you a couple of trade ideas, or not ideas, but trades to illustrate the components of the butterfly and how they really do lower your capital at risk and provide some really big returns on that capital. So the first one I want to show you is a directional option butterfly spread, and this is on GLD. So this is basically your vacation trade, as you're going to see. So they're great for ETFs because they're very liquid, etc. But this was on GLD, the gold ETF. Okay, so this was a directional trade setup just using a balanced butterfly. So, for trading, when I trade something, like I said, I like to look directionally is the first thing I look at. And in this particular trade setup, the entry was on the 5th of January. So this was based on our trading model, and the momentum for gold had been hard to the downside, as you can see, just got crushed. So we were looking to see if there was going to be a potential bottom in this area. So we have our momentums down here. You can see the arrows. This is what we call momentum indicator, cycle 1 and 2, are above 0, and potential for gold to start, pushing to the upside. But with this huge move down, we were looking for a really low risk trade that had a really good potential for reward. So here was the trade setup put on January the 5th, right about here, right here. And the next thing I always do is I look at targets, and I base targets off of Fibonacci analysis. So doing a Fibonacci swing high to low analysis here gives me my target points to trade against and to set up my option spread. So here's target 1 at 382 at 113. We'll call it 114. Here's target 2 was right around 115. So that was the area that we were looking for a move to, the 50% retracement, good high probability that it would retrace back there. Plus, there was huge open interest, both calls and puts, at the 115 strike. So we set the trade up when it was trading right here at $112, and we set it up for a target to 115, and for an expiration. This actually was one that went out not this last Friday, but the Friday before. So it was a monthly option setup so it had not quite, it had 15 days until expiration, but our target was $15. So it was a balanced butterfly, and you can see here's the structure. It's going long a 114 call, and let me get my pin here. So long a 114 call, short the 115. So if you look at this, this is a long call debit spread, so that's part of the trade. And then the other part is selling the 115, buying the 116. So if you look at that, that's a bear call credit spread. So the two combined together, there's the body of the butterfly, creates a balanced $1 wide spread butterfly. So the max risk, it's a dollar wide spread, so that's $100. The cost of this trade was $9. So the difference equals your potential theoretical profit of $91. So the maximum you could lose, if everything went against you, you would lose $9. But theoretically, if it went out at 115 at expiration, you could make 91. Now that's over 1,000% return. That's 11 to 1 reward to your risk of $9. So this trade was, put on the 5th, and basically you could just walk away. You didn't have to look at this at all because you knew your capital at risk was so low, and then just started monitoring this trade the last week of expiration. And then here's what it did on that last day. So it took off, started taking profit that week, but the last part of the profit was taken right on the last day, and it was $76 per option spread. Now, on a risk of $9, that's 844% return on your capital at risk of $9 for one spread. So here was the debit, $9 or 9 cents, $9. Here's the spread, 114, 115, 116, so dollar wide. Max theoretical profit 91, max risk 9. And here's how that profit tent looked on that Friday going out. So here was GLD on the 20th. That was expiration day, and it was going out right towards the end of the day, right around 115.18 right here. And so see, you can barely see that purple line, but it's right up here to the top of that tent. So that's about as good as you can get, max profit. So the trade was put on at 9 cents, and this thing went to an 81-cent debit. So 81 less 9 is $76, okay, for one option spread. And you can see here, if you just did 2 contracts there, that's over $145, or 76 per spread, 844, return on that capital at risk. So that's kind of the butterfly vacation. Now this is the one I like the best. This is the unbalanced ratio butterfly. I like this one. And for any trade I'm looking at, I try to see if I can do this kind of setup first. Now, what this is, it's a variation of a regular equal strike butterfly, but what it does, it adds an additional short vertical credit spread. That's the key. It's additional short vertical credit spread. So it's simply 2, the way I like to set it up is 2 in-the-money credit spreads, and then it's protected by a slightly narrower, closer to the money debit spread. So that's what gives it the great structure. You've got that credit spread for your theta decay, volatility, implied volatility crush, but you have a debit spread embedded in it that offers you some protection as well. So what it does, it provides you a very low defined risk directional strategy. And then by using either puts or calls, that's how you skew your direction for either up or down. So the strategy basically alters the risk of one direction, increases that potential reward to the direction you're skewing it to. So here's GLD, just the same strategy setup on this day, but doing it as a ratio butterfly, still looking for that target on this trade of 115, but doing it with a ratio put butterfly. So the trade was set up again the same day, just a different structure, and it was looked to for a target of 115. So the actual credit, this received a credit of $70 per option spread. So it's a dollar-wide spread, so that's $100 less the credit you received of 70. That puts your risk at the difference. So the maximum risk is $30 per spread. Now, your potential max profit theoretically was at that 115 strike if it goes through at expiration, 170. So 170 divided by your risk, that's potentially over 500% return. Now it's got positive theta, that's one of the advantages, and you've got a number of different profit points. Now this trade actually on the 20th as expiration, it went out, it made $151 per option spread. Okay, so 151 per spread, risk of 30, over 500% return in 15 days, versus if you bought the GLD ETF, you'd 2.5% return. So great risk reward, and here you see you received a 70-cent credit. So if it went straight up past that 115 strike over 116, you keep the 70 credit, and that's still a fantastic return. So you can see here 116, 115 put spreads, so that's a vertical debit spread. Then you've sold 2 bull put credit spreads at the 115, 114. So that's that embedded 2 credit spreads inside of it. So here's what the profit tent looked like on that one going out on Friday the 20th. And it got about as perfect as you can get. So these rarely happen, but it was a lot of fun. So on expiration, it was going out right there at 115, okay, almost to the penny, 115.10. So you can see that purple line right up there at the top of that profit tent. So where it was right there, that was a profit of $151 per option spread, or 500% return on your capital of risk of 30. So here's the 70-cent credit. Now you can see how that flipped from a 70-cent credit to an 81 debit. So, you know, 2 contracts on this, or 2 spreads, was over $300 on a risk of just 30 cents per spread, or a total of 60 bucks. So awesome trade setup there. So that's what that looks like. So great reward to your risk. So, you know, what I wanted to cover here today was just all the various inputs of what makes this such a great strategy to use. So, and then that theta decay and the implied volatility, that's the real core, you know, benefit advantage to this butterfly strategy. So if you'd like to learn a lot more about how to master these high reward, low risk strategies that work in any market environment, I'd like to show you a really good package. Very, very also great return on your capital. And this is a course that I did. It's 100% on the option butterfly. So it's a 4-hour course that I did live, and now it's, you know, on demand. So it's broken down in 30-minute modules. Now here's the link. Just use that link. It's powercycletrading.com/best. So use that link there. Just copy that and put it into your browser, and I'll go through and show you what all's in this course. And I've got some good bonuses here too for you. But if you've never traded options, or if you've never traded butterfly, here's a great way, or great opportunity for you to, you know, try it out, see how it goes. So powercycletrading.com/BEST, and I've got 20 spots. So one of the bonuses here is that you're going to get also a live Q&A follow-up as part of the package. So this is the Amazing Option Butterflies course. It's a 4-hour plus course. On demand. You get the 30-minute modules, so it's about 7-8 modules, 30-minute modules, and then we'll do a live follow-up Q&A, which will be about an hour. So this will be in about 2 weeks. Give yourself time to go through the course. I'm also going to give you as a bonus my option strategy manifesto. This is 15 of my favorite strategies, and it's a nice printout you can put on your desk. Explains the strategy, shows the diagram. Bonus through my Greek power guide, so this gives you the option Greeks you can put on your desktop. And if you've never been a member to my trading club, you're going to get a free trial membership to my trading club, and then if you stay in, it's $97 a month. Now, so you'll get the on-demand recorded course, 30-minute modules, and and also the PowerPoint is 213-page training manual of the course. So my courses are very detailed. If you don't like it, you get, you know, a full refund. Just send us an email. We'll send back your $97. Here's just a little feedback. I said, Larry, I have to tell you that you are an enormously talented teacher and admirably humble despite. Bravo. Wish there were more people like you in the world. Shams. This is from another, you know, member client, 10. Says, thanks, Larry. This is one of the best 4-hour presentations I've listened to this year. I'm also left imagining the opportunities available for having fun and making dollars at the same time with this knowledge you imparted on us. So just a little bit of, you know, feedback there. Now in the course here, in the course you get, this is what you're going to be covered in here, the core basics of the butterfly, the Greeks that are important to it. Then we're going to go through in this course how, why, and when to use the long call put butterfly, broken wing, ratio, directional butterfly, iron butterfly, vacation butterfly, how to pick your strikes, what is option pinning, you know, how to use that. And then another thing that we'll do in the course is price target analysis for Fibonacci. How do you, you know, pick your targets like I showed you earlier, step-by-step checklist, executing. And then a big part of the course, the biggest, most important part, is using butterflies for hedging. So it's a lot there, but it's all of it. It's going to be stuff that's super useful to you. And if you're interested, you'll get this as my printout, 20 option strategies there, power tool guide for the Greeks, and club membership. We've got a virtual trading room, nightly videos, discounts. I've got all kinds of trading models I've developed. You get 50% off that. So great course. And thanks for everybody being here today. And here's that link one more time. I know I'm out of time, so sorry to rush through it, but I just want to make sure you got everything there.